And here we go with another episode of Realty Experts. Welcome, Darcy.
Thank you, Keith. How are you today?
I'm great. I've been up since 3:45. Got on a plane this morning. Flew over here. 3:45.
3:45. What time zone?
Oh, I'm still in Pacific.
Oh, okay.
Yeah, I'm still in Pacific. Just the Panhandle. So I live in Coeur d'Alene now. So the Panhandle is technically in Pacific Standard Time. Once you get to the border of Montana and Idaho on the eastern side of the Panhandle,
then it switches.
Then you switch into Mountain Time. It's really crazy. There's a snow park up there called Lookout Pass, and literally you have to drive into Montana to take the exit to come back into Idaho
to go to Lookout Pass.
So yeah, so when you get off the freeway, the time changes, and then when you get to the parking lot of the snow park, it changes back. So like you have about 30 seconds where you lose an hour and then you gain it back. But anyway, that's kind of funny. That leads right into our theme today, that times are a changing.
They are.
Just like time zones, when you cross over that line, like we've crossed a line. We've crossed over a line.
We have.
And
I cross over lines regularly. But.
We're going to spend today's show kind of jumping into data points and mindset in the real estate market today.
Yeah.
There's a lot of misinformation out there. I've got a very good headline that I want to share with you guys today. That is, to me, it's a little bit doom and gloomy. But if you actually know the other side of the headline, it's actually really great. So what I would say right now in today's market with the times of Changin, make sure that you're looking at whatever you're hearing, whatever headline you're reading, jump into that article. And what I found is usually the real litmus test and what's really going on is probably in the bottom third of the article. The top 2/3 of the article
or the footnotes.
Yeah, or the footnotes. Oh, by the way, it's really not that bad. With that being the case, I think what we'll do to start times of changing is we will rate the rates. Here we go.
Rate the rates.
Okay. So as of today, when we're recording, the Fed met. The Fed met today. So we're recording today on the 15th of June, and the Fed met today, and they announced that they're kicking up the interest rates, the Fed funds rate by 3/4 and prime by 0.75%, right? Awesome.
Highest increase since 1994.
Huge. This is huge. So this is finally a statement piece, right? We've been living in this state of transitory inflation ever since COVID started, and we've had all these issues with supply chain and pushing up prices on stuff. And then all of a sudden, after 2 years of spending a bunch of money that we've printed at the Fed, now we're like, oh,
there's an effect to that.
Time out.
Look at that.
When a government prints money, there's an inflationary pressure that builds up just like a volcano, and it explodes all over the place. And that's what's happened. So we're living it firsthand. So for all of you out there, this is like some historic inflation numbers. So just know that we're living through history right now. So
that's something we're pretty used to doing right now for the last few years.
Cool. But so pandemic now, inflationary pandemics. The interest rates.
But I want to back up for a second.
Oh, okay.
Because people talk about the interest rates going up, and then they think about mortgage rates and think that they're actually the same thing, and they're not.
That was the leading question I was going to ask you.
Oh, cool.
Yeah.
Okay. So they're not at all.
Yeah. So which way do you think mortgage interest rates went today with the Fed's fund rate and prime going up, Darcy? Did they go up or down?
Well, naturally, one would think that they went up.
No, they went down.
But they went down.
Yeah. So it's really important to understand that, yes, the short-term interest rates that the Fed gets to play with go up, go down. They have an impact on our economy. Sometimes they have an impact on the mortgage market. Sometimes they don't. What has huge implications on the mortgage market are two things right now. Number one, inflation.
Yeah.
Right? When inflation goes up, mortgage rates go up. And because they're like, oh man, This is not good.
It's costing more.
It's costing more. So it puts upward pressure on that. So why interest rates got better today is because the bond market, where we securitize all of these mortgages that we're underwriting, the bond market said, finally, the Fed is doing something about inflation.
Yay.
They're actually making substantial progress in the bond market's eyes towards curbing inflation. So that's a good thing. We got a little win today. Is it going to continue to go forward through the summer? No. We're gonna give up what we got back today because we're still going to see inflation numbers continue to climb through the summer. I hate to be the bearer of bad news, but that's where all the headwinds and where all the data points are referring us to. So just know that, inflation, though it's probably not going to pound out almost 10% like it did last month, we will still see relatively high inflation numbers, nowhere near where the Fed wants it. So I also anticipate once we jump into August and they're meeting again at the end of July.
July, right?
That they will again look at doing some more corrective action, which will be
and
good.
they told us that. They have outright told us expect a lot more upward action this year. But okay, so I want to go back and define for people.
Okay.
When the Fed raises rates,
right,
what they're actually raising is what's called the federal funds rate.
Federal funds rate.
That is the only thing they have control over as far as rates.
And if you're the Bank of Darcy, and I'm the Federal Reserve window, or I'm another bank, and we want to lend money to each other, that's where that rate is. Right. It's so bank to bank.
The federal funds rate is how much they get from borrowing money from another bank overnight.
Yes.
That's all it is.
Right.
Okay, a lot of people get confused by that. But when you raise one thing, it trickles into other things. There's a higher cost to borrow for the bank to borrow.
Credit cards.
Therefore, the banks have to charge more when you're borrowing money from them.
Yeah.
Simple.
Yeah, so the one thing that we will say about what happened today, you'll see a direct impact in those credit cards.
Yep.
You'll see a direct impact in your home equity lines of credit if you guys have one. I have one, right? So if you have anything that is tied to the Wall Street Journal prime interest rate, you will see an increase in your payment.
Yes.
Right? And each individual lender is a little bit different as far as how they wrote their credit card statements or how they wrote credit card notes and how they wrote their home equity lines of credit notes. But long story short, you're going to see that manifest either on a monthly basis or on a quarterly basis. I was talking to one of my friends at a credit union, and he goes, "Yeah, I think our clients are in for a shock because we don't adjust our HELOCs, our home equity lines of credit, except on a quarterly basis, not on a monthly basis."
So it's going to jump fast.
It's going to jump like over 2 points on those folks at that credit union. I'm not going to name any names, but just know this. If you can answer yes to this question, do I have a HELOC, yes or no? If you answer yes to that question, you will, in the near future, the next 60 to 90 days, be getting a letter from your company that services that mortgage saying, hey, guess what? Prime interest rate went up, and so did your payment. So,
for anything that you are borrowing that's based on prime,
right,
it's going up.
It's going up.
Credit cards, any student loans that are adjustable, all that.
Yeah,
type
if they're
of stuff.
based on prime.
If they're based on prime, which a lot of them have been in the past.
The biggest one is credit cards. So
massive.
So it'll ratchet up. So if you're just making the minimum payment now, that minimum payment just got a lot bigger.
Right.
By 0.75%. So,
and it's going to take you a lot longer to pay that off. So pay it off.
So looking forward, this is a pretty cool thing. We're going to bring up slide number 1, the interest rate history for you guys.
Yeah.
And it sounds all horrible that rates are going up and this and that. There is relief on the horizon, and that's where I want to leave everybody with a warm and fuzzy, right? If you go back, and as you guys can see on the chart, this is the Freddie Mac mortgage survey for the last 50, 60 years, right? Back to the 50s. What happens, it's historically accurate that rates peak up, we jump into a recession, right? We hit the wall of a recession, and right after the wall of the recession happens, we start coming back down the other side. So it's very much my opinion and very much my forecast that we're going to get through a tough summer of love. And then on the other side of it, it's going to be all sunshine and butterflies. So when those sunshine and wait, it is June, you guys. We haven't had any.
We haven't had sunshine here at all.
It made me miss the sunshine for a second. That was a total squirrel moment. But the sunshine and butterflies is going to come on the backside. So with that being said, it's still a great time to go buy a house. It's still a prudent time to go buy a house, especially if what you're doing right now is rent. Because as we've been talking, and we're going to switch gears a little bit here and start getting into the mentality right now of our buyers and our sellers in the market. Buyers, a lot of them are still first-time home buyers. The millennials are coming in hot, and the National Association of Realtors pulled a bunch of millennials here this past month. Still, 72% of all millennials say that buying a house is in their lifespan dreams and goals. The American dream is still very much alive and well, and they represent the biggest portion of our society coming to the housing market.
You know, it's so true. And it's funny because when you talk to millennials, they're freaked out by rates. Yeah. But when you talk to people like baby boomers, they're like, seen it, done it, not a big deal. So it is very generational on how people look at the rates right now.
So if we can bring up the interest rates again, the peak, and this is why the baby boomers like, whatever. Whatevs. The peak happened in October of 1981. October of 81, we peaked out at 18.53%.
Ouch.
Yeah. So boomers are like, oh, wow, we're good. This is like a third of what I used to pay. So we have that recency bias. What we're not hearing in the news as much as rates are going up, we're not hearing how rents are staying up with those increases in rates.
Oh my goodness.
So
yes.
Tell me what you're hearing from your first-time home buyers right now. Specifically a first-time home buyer, right? I'm renting right now. I'm either in a house or an apartment.
Right.
What are they coming to you with?
So it's a mixed bag, but the one common thing with all of them is, holy cow, my rent has gone up X amount of hundreds of dollars a month for the next year. Yeah. And I remember this a few years ago. We were renting a house and our landlord decided he was going to charge us $700 extra each month for a renewal. And we said,
What percentage-wise, what was that? Like a 20% increase? 30?
Hold on. Math.
How much were you renting?
I gotta remember which place it was. I remember which place it was, but
we call this brain fog.
Yeah,
brain fog. Anyway,
it was probably about 20. It was probably about 20%.
$700 a month is a substantial chunk of change. I mean, because when we look at that and extrapolate that, that's over $8,000 a year.
Yeah, that's huge. We said no and we moved, but a lot of even very, very inexpensive. I mean, they're expensive for the rest of the country, but very, very inexpensive apartments that people move into right out of college because it's all they can afford, stuff like that. Even those are going up like $400 to $600 a month.
Right.
It's ridiculous. So a lot of people are trying to enter the market because of rent going up so much.
Yep, that's what I'm getting.
That they want control. They say, I don't feel like I should be buying a house yet, but I can't keep on doing this payment year over year. I have no idea what's going to happen. I need some sort of control.
Yeah, and that's what buying a house gives you. You know,
it does.
If you got the income and the down payment, and in some cases you don't need a down payment. We can talk about that later on a different show or later this afternoon, whatever. But buyers are like, I need to stop the bleeding of the rent.
Yeah.
I am hemorrhaging money and it's going nowhere. And I've had a couple conversations just this week. They're like, yeah, I get that rates are high, but it's a little bit higher than our rent. And I know that payment for principal and interest, it's not going anywhere.
Yeah,
I'm going to get a 30-year fix and I'm fix it and forget it. Set it and forget it, and ding.
I mean, it can adjust, the payment can adjust slightly because of taxes and other things that adjust, but the loan portion of
principal and interest balance of the mortgage.
If you're getting a fixed rate, it's fixed.
Right.
It's fixed rate.
So we got buyers, first-time home buyers specifically.
Yeah.
They're trying to stop the bleeding of the rental market, and I totally understand. And I think it's great.
And that's not going to stop anytime soon, I have to say.
No, supply and demand. We've talked about it numerous times on our show, and if you are listening to a well-rounded commentary on the housing industry, we still have a severe shortage coast to coast, and it's been.
Well, you want to talk about inventory?
We can't. I got another buyer that I want to talk about. Now let's talk about the move-up buyer.
Yeah.
Right?
The move-up buyer.
The move-up buyer. It's very interesting because I think this market niche is very polarized. They're either in one camp or the other.
They are.
What two camps are you seeing?
Okay, so there's I have a massive pain point that I have to move to get out of that pain point, such as I bought this house when we first got married.
Yes.
And now we have three kids.
To go.
The oldest is going to be a teenager soon.
Yep.
And they're sharing a bedroom, and this is just not working anymore.
Yeah.
The people that tried to really hang on through COVID of we can do this, we can just be close, and they're finally saying, I can't do this anymore. That is most of my clients right now.
Numero uno.
Yeah, that is numero uno. Numero dos.
So those are the highly motivated. The other one that I would put in the highly motivated camp are the folks that are very deep in equity, and they're like, hey, I'm going to take this opportunity with a little bit more inventory on the market. I may not sell my house for the top dollar, but I can go get the next house, and it'll be a little bit higher interest rate, but I can get where I've ultimately the dream house, lock that bad boy up. Those folks, I've had 2 conversations with those types of buyers that they just purchased recently at like $900,000. Now they're going to the 1.6, 1.8 ballpark because they see the opportunity on the forefront.
I'd add part of that group is the people that need to go contingent.
Yes.
Because we are starting to see people putting offers in and getting them accepted that are contingent upon them selling their house. Okay. Now remember, if you're buying and selling, it doesn't matter which market you're in really, because you're either getting the highs on both ends or you're getting the lows on both ends. It doesn't really matter. But what does matter is the stress level and the ease of doing this transaction. And for a lot of folks, certainly not everybody in this area, but for a lot of folks, they'll require the equity from the sale of their house in order to purchase the new one. And they did not feel comfortable doing something like a bridge loan or taking that extra risk and taking the money out of their house earlier to buy faster.
Okay, so the stress level that you're referring to in the contingent sale is like getting under contract on your new house and then having to bring your house to the market, sell it, and reorganize your life.
So there's stress no matter when you're doing it. Like if you're buying the house first, moving out, getting your house ready, and then selling it, there's massive stress because, oh my God, what if we just bought at the top of the market and then things are going to go crazy and we're stuck with this house and what if, all these what ifs. If you're selling contingent, I don't actually have to go through with the purchase of that house until my place closes, which is a relief for a lot of people. However, the way our contracts are written in the western part of the state is unless your agent changes it, and most won't because of various things, then you have to have your house on the market within 5 business days of getting the house you're purchasing under contract. So when I have clients come to me and say, hey, we want to buy and we want to sell, but we want to do this contingent, I say, okay, let's get your house completely ready to go on the market. Let's take the pictures. Let's do all the stuff ahead of time so we can get the place under contract and immediately put your house on the market and it's not stressful. But does it always work out that way? No. Because they start thinking about it and then they call me the next day and say, oh my God, our dream house just hit. We need to get this house. And we get it. But then that whole list of things that we said needed to be done either needs to be rushed or we need to cut some things or whatever it is. Yeah. So that's where the stress often lies. Right. And then that whole people coming in to see the house, waiting for it to get under contract so you know you can actually go through with your dream house.
Yeah, so we Melanie and I, we went contingent once.
You're like never doing that again.
Not going to do that again if at all possible.
I mean, if you don't have to, awesome, good for you.
And here's why: the transaction was we found the house that we wanted to go to. So then, to your exact point, we had to within 5 days get our house ready, listing ready. So that meant clean everything out, get the proper staging in it, get the pictures done, and then get it on the market. And then this was in 2018. So this is when we had a little blip in the market where we kind of slowed down a little bit. Mm-hmm. And really all the market did was take a breath over the summer months, which I think we're going to see a very similar environment this year, is that we're going to take a little slowdown here through the summer months, and then we're going to just get going in Q4. But what happened was then we had two small children at the time. At the time, I think
they still have those kids, by the way.
Yeah, we still have the kids, but they were small. They were
they were much
4
younger.
and 6.
Yeah.
But when you get the call and say, "Hey, you got to be out of your house because somebody's going to come look at it,"
it's hard.
You run around like a Tasmanian devil trying to clean up your house, get the kids you strap the kids into the car seat and leave them in the car.
And then run back inside.
And you run back in, clean everything up, and then run back out. So there's a lot of chaos that goes on with that. There's a cool thing, and I don't think you know this yet, Darcy. There's some new underwriting guidelines that came out specifically for our jumbo buyers over the $647,000 loan amount. Uh-huh. If you have enough reserves, if you have 2 years worth of reserves for the house that you're leaving. 2
years.
2 years. Okay. Yeah. So 24 months worth of reserves, which a lot of people do. We don't have to count the house payment against you.
Oh, that's new.
Ta-da! I know it's new. I didn't tell you that. We just released a couple new guidelines. So that is one of the new guidelines that is out there because they're trying to help people make that jump from one house to the next. So just to rewind this, let me make sure that we're really clear. Let's say I'm going to buy a new house and my departing residence is $3,000 a month. Right. So the house that I'm leaving is $3,000 a month, $36,000 a year. Right. So I have to have 2 years in my bank account. Right. So we get up to $72,000. So that can be in the form of a lot of different accounts, stock accounts. It can be part of your 401k.
It can be part of retirement.
Your retirement accounts. Okay. It can come from multiple purposes, right? So as long as I have, and the bank says, hey, after closing on your new house, you have 2 years worth of payments for that departing residence, we don't have to count that debt against you.
But that's only on jumbo.
That's jumbo, yes.
Okay, so
Fannie Freddie don't like that.
Yeah, they don't like that.
Fannie Freddie say you need to have it under contract with the finance contingency crossed out.
So that's really
or satisfied.
Big because before this, you had to qualify for both
payments.
The payment of the departing resident and the payment of the new resident within the guidelines. So if the guidelines say that you have to have all of that money as only like 45% of your income because you have the rest of it to pay for other things, that's a hard one to do.
It gets deep fast.
So that's pretty good. Questions. I know questions. in we're talking about reserves.
Yep.
In past times for Fannie and Freddie, they have had higher reserve requirements. Meaning in past years, for various different loan products, they would insist you have at least X amount of months of money in your bank account that you are not using
reserves, yeah,
part of your down payment or anything. So forget about contingent house or whatever. This is just to buy.
Yeah. So if you're coming out the gate right now for Fannie and Freddie, there's not too much weight put on how much money you have left in your bank account.
Is that going to change?
It very well could be. Right?
Because this is huge in my eyes.
I love our theme. Times are a changing.
Yeah.
Because here's what happens, foreshadowing a little bit when we do get into and we cross the line of recession, right? Fannie Mae, Freddie Mac, and jumbo underwriters, they don't like that word. It's not a really great word for them. So they do tend to get a little more conservative.
They do.
In a recessionary market, right? We're getting right up to the top of it, and we're going to go off the other side. So once we start going off the other side, you're absolutely right, Darcy. We're going to see changes coming out by underwriters and mortgage bankers, and they're going to kind of tweak their guidelines a little, right? I don't think we'll see anything substantial. Like we saw a huge knee-jerk reaction when COVID first hit. When we went into lockdown of March of 2020, oh my gosh, every single day I would walk into the office and we'd have a new underwriting guideline bulletin that said, hey, X, Y, and Z changed on credit score requirements. You have to have X credit score as opposed to, like FHA was very notorious. They jumped up from a 580 credit score up to a 620. And then some lenders even took that one step further and went up to a 660.
It was crazy.
Right? So you could have been pre-approved at that point for a loan. One night, you go to bed, oh yeah, I'm going to go look at another house tomorrow. And you get a call from your mortgage person the next morning and say, oh, hey, I know we said you were approved FHA, but FHA literally last night just changed their underwriting guidelines to require 620 credit score.
I love how you said the next morning you got a call from your loan officer, because that's what good loan officers did. But you know how many people didn't get that call and got into contract and then weren't able to close on the house that they thought they were going to buy because their loan officer never told them they no longer qualify?
Yeah.
I'll get off my soapbox. Yeah.
I called my clients and my agents.
He did.
So that is one thing, a little cautionary feather in the wind kind of thing. Right now, we're going through that transitionary period. Once we get into a recession market, you will very much so see underwriting guidelines change. And keep in mind, underwriting guidelines can change up to the point of recording with the county, right? Until you go in and sign those final docs at the escrow company and they record that at the county clerk's office.
Which there can be a few days between the time you sign it and the time it gets recorded.
Totally. So just keep that in mind, that things can change. Still a great time to buy a house. I just want to make sure everybody's going into this with eyes wide open.
Right. So I want to dig into that piece a little bit more further. So
which piece?
That. Okay. So let's say first-time home buyer.
First-time home buyer.
They're looking at buying a house, whatever purchase price. They have, let's say, I don't know, $70,000 in the bank for their down payment.
Okay.
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 Let's just say that their monthly payment's going to be $4,000.
Okay.
Okay. Also, let's say underwriters change the guidelines and now require 6 months worth of reserves.
Right.
In order for you to buy that house.
Okay. So 6 months, after you pay the down payment and the closing costs, you have to have 6 months worth
You still have to have 6 months. You can't use that $70,000 towards it.
6 times 4, that's $24,000.
Right.
Right.
So you have to have $24,000 just laying around that you're not going to touch in order to go through with that. And that's a conservative 6 months. Like,
yep. Now,
not a lot of people have that.
Nope.
A lot of first-time home buyers are saying, I've got 5%. So they're not even at the 70 grand part. So all of a sudden, instead of being able to qualify for this amount, they can only qualify for how much they have in reserves.
Correct.
For their payment amount.
Yes.
Therefore, I kind of feel like if you're a first-time buyer, if you're in this situation, if we expect things are going to change this way, maybe you should jump in the market now before you're required to have those reserves.
Yeah, and you know that happens on every single facet. Remember, in the mortgage, we look at 4 things, right? We look at the house, the collateral.
Yep.
We look at your capacity to repay in the income that you're bringing in, right? So debt to income ratios could change, right? They do. They could go up, they can go down. So credit's the next thing. Credit standards can change from a 580 up to a 620, a number of trade lines that you have. So, and then finally your cash to close. But all of those things are in play when we get into a recessionary market, right? So what we're saying right now is you have to prepare yourself for the market that you're buying in and the market that you could be buying in the future. Yeah. Because that's where a lot of folks don't see the blind side. The blind side is, I'm shopping right now, but some of our clients we've had clients take 2 years to buy a house, right? So the market 2 years ago
could be the good ones.
Could be substantially different than it is today. So just know that's why my mortgage disclosures, anybody's mortgage disclosures, has that little asterisk that says your rate and terms are subject to change at any time.
And we're telling you right now that we're coming into a time that we really expect them to be changing. Yeah. There's obviously nobody would foresee, hey, pandemic coming. Of course they're going to change.
Right. That was
forgive us abrupt. For that one.
That was pretty abrupt.
But this is a time we know they're going to change. So if you're thinking about getting in the market, now's probably a good time to do that. And I don't say that lightly because I feel like realtors and lenders always think it's a great time to buy. It's not always true. But I would prefer if somebody's looking at going down that path that they jump sooner rather than later. Because if rates go down or something like that, you can always refinance, right? There's always things you could do.
Okay, you totally sound salesy, like jump in and get it now.
I hate it.
But here's how that looks, guys. Pick up the phone. Call a mortgage person.
Dial.
Call me. You can call me 206-713-9063. Pitch Mortgage Team, licensed in 11 states. Pick up the phone and see what is possible.
There's no requirement.
The conversation is free. There's no requirement to make a loan. There's no requirement to buy a house. But you don't know what you don't know until you know it. Yeah. Right? So many of my barbecue friends and my fellow soccer parents are still just petrified to pick up that phone because here's what they're afraid of. This is like an emotional moment. They're afraid of the no. They're afraid of no, you can't buy a house. And I'll tell you this, with the proper plan in place and the proper execution of said plan, you could buy a house. You just need to know what hurdles are in front of you. And so what I would hugely, hugely advise everybody to do, if buying a house is on your mind, pick up the phone and have the phone call, right? And then you'll know what's possible.
It's amazing.
Yeah. So that concludes that part.
Yes, that's our piece.
Things are changing. Times are changing. The other thing that is changing that we have not talked about is Darcy didn't silence her phone.
I did silence it. It just buzzed.
It just buzzed.
It's a client. Sorry.
Fair enough. So
Kimberly, I'll call you back later.
Oh, yay. So let's talk about the sellers. What are sellers thinking right now? Because it's a very interesting time if you're a seller.
Such a great question. Okay.
Sellers out there, if you're thinking about selling or you're talking yourself out of selling, let's talk about what a seller's thinking.
Yes. So I have gotten quite a few calls lately about, I want to sell my house. I think it's finally time, blah, blah, blah. All right. So I go to the appointment. One of the first things that I'm asking my potential clients these days is, what? That's not me buzzing.
Is that me?
I just want to say that's not me.
Oh, it's me this time. Oh, man.
Somebody didn't silence his phone.
Oh, it's Michael.
Oh, wonderful.
We'll call Michael back later.
Michael back later.
Michael's our builder friend.
So in the event that they that I'm sitting down with them and talking to them about selling their house, this is the thing that I immediately ask. And I never used to ask this, but nowadays I'm saying, okay, tell me what your perception of the market is right now.
Ooh, that is a great question.
It is a good question. It's changed so fast that there's a lot of people that are 4 months behind and they're like, well, my perception is I can put my house on for whatever I want and I am going to get 27 offers within 12 hours and we'll just go off and buy the next house. No, that's not where we are at all anymore. So I have to reset that.
They must not have cable news.
There's other ones. Well, there's a lot of people that don't watch the news because it's always doom and gloom.
Yeah, well.
There's other people that are saying, I feel like I missed the market and I don't want to completely miss it. Like, I just want to capture the end of it. Right?
So they want to get the market on its downward trajectory,
yeah,
they think?
Yeah, that's what they think. That's what they think. They're like, right. So we have a lot of conversations surrounding what their motivation is for moving because it makes a huge difference what they plan on going to. If they're moving out of the area to a place that's much cheaper, they're looking to capitalize on the money. It's one thing. If they are trying to get away from the house that's just way too small for their family, completely get it. If they're like, I don't know, I'm kind of stagnant with this, then we have conversations about, well, what would the impact financially be to you if you move right now? So sellers can be all over the place, and more than ever, the intent behind the sale and what the numbers look like are playing a bigger and bigger role.
Yeah, the intent beyond the sale is a huge motivator. One thing that I think both first-time home buyers, move-up buyers, and sellers are taking into account right now is their cost of funds, right?
Yes.
Most recently, we've had this huge recency bias of amazingly outrageously good rates.
Yeah,
right?
Money's cheap.
Money was super cheap.
Yeah.
And so we got spoiled for 2.5 years. And now we're getting into a normal market. And, you know, when you look at, hey, I've been paying X and now I have to go to Y, it can be a little bit of a sticker shock. And so what I would say to that is, again, interest rates are ticking up. We're getting into a recessionary market. What goes up will come back down, right? Fundamental number one. Number two, when we look at the long-term view of the asset, right, we have to then take out the emotional piece of, oh my gosh, interest rates went up, blah, blah, blah. We need to look at what the financial impact is, and we can model out where you're going to be, how much equity you're going to be in that house in the next 5, 10, 20, and 30 years, and what that appreciation rate will look like. And then once you get the full disclosure of all the information, you have the intent that you need to move to the bigger house or what have you, and then you have the financial piece plugged in with the data points saying, hey, in 5 years, I'll have X amount of equity, and then in the next 5 years, I'll have even that much more equity, and the house is still a solid investment, right?
Yeah, I mean,
that's what all comes together.
Yeah,
you have to put those two pieces of the puzzle together.
So I had a client last week. They saw, oh my God, my house is worth $1.9 million on Zillow. We had to have the whole Zillow doesn't tell you what your house is worth conversation. But besides that, they were still under the mindset of they put it on the market for whatever they want, they're probably going to get $400,000 over asking.
Oh,
we're no longer in that market. Okay,
well,
so we corrected that.
You could just list the house at like $600,000. I'm sure they will get
$400,000
over asking.
Okay, so that's the number one part. The other part is most people that have been in their house for more than 4 or 5 years are hitting capital gains. Okay, so we're gonna
let's talk about
we're gonna dig into this one a little bit.
Let's talk about that because this is a little gremlin, a little troll hiding under the bridge.
You know, I never used to have this conversation, and I feel like every single listing appointment that I'm going on right now, I'm having this conversation with. Okay, capital gains. If you have lived in the house as your primary residence for 2 out of the last 5 years.
2 of 5.
And you are a single individual.
Yes.
You can be forgiven for $250,000 worth of capital gains. Meaning you don't have, so if you bought the place at, let's say, $1 million, and you sold it at 1.25, that's me. University of Virginia. Calling early this year. Okay. And you are getting, you're selling the place for 1.25.
Right. So you got $250,000
So
gain.
you have $250,000 gain. The government's not going to charge you capital gains on that. But if you sell it for 1.3, you will have to pay capital gains on that $50,000.
Yep.
And the capital gains amount can look like.
Talk to your CPA. It can look like a lot.
It can look like a lot of things.
A little.
But it's not strange for it to look like 20-30%.
It's applicable. And it can put a sizable dent in what you're trying to do in the next iteration of your money.
So that's a single person.
What if we're married?
Is a couple that's married or bought the place together, $500,000. It doubles.
Doubles.
Okay. So you bought a house, I don't know, 10 years ago for $500,000.
And
now you can sell it for 1.5. You have $500,000 that can be forgiven as a couple. The other $500,000 profit, you're going to have to pay capital gains on. Now that's if you've lived in the house for 2 of the last 5 years, and there is no wiggle room on that 2 of the last 5 years. Now
that was what the kabam was for.
If you moved out of the house, have not lived in it, like let's say you used it as a rental.
Right.
There's no forgiveness.
Bought it as a rental, used it as a rental, selling it as a rental.
Or even lived in it.
For less than 2 years.
No, even if you've lived in it for like 10 years and then moved out and you've rented it out for the last 4 years, it's now rental property and you no longer get that. So that's even worse, right? With the first example we were looking at, you're getting $500,000 is going to have capital gains tax paid on it. This new example, you're looking at all $1 million having capital gains tax on it. This is a lot of money. So people are coming to me thinking, oh, this is my big money maker. And I'm not saying you're not making great money on the property, because you are.
Yes.
But I need you to understand it's not like you're going to the candy store and getting to pick out everything you want and walk away with it. We live in a world with taxes.
Yes. Taxes are good.
So I'm seeing a lot of that. I've had that conversation every single listing appointment lately.
It's a very valuable conversation. And, you know, when you look at appreciation rates that were 17%, 20%, 24% year over year for 3 years straight, it's pretty substantial gains year over year. So you can get there really fast. So you don't have to have owned that house for the last 10 years. You could have just as recently bought that house 3 years ago and still be facing a capital gains event. Not saying this should not hold back people from buying or selling. You just need to make sure that you know what your true net number is, so you can make sure that you can execute on your next step.
Exactly.
Also, if you're not working with a really awesome CPA and tax planning professional, you should seek one out.
Absolutely.
We have great referrals for you. If you need one, just drop your name and say, hey, I need a CPA tax professional who can get you hooked up.
Yep.
So
I want to...
Let's put a pin in the seller.
Yeah.
Have we pinned the seller?
I want to move to inventory.
Oh, inventory. So sellers...
Is that cool?
Well, sellers just think there's no inventory out there.
This affects everybody, buyer, seller, whomever. Okay, so we're going to put this up on the screen for you. It's months of inventory. This particular graph is just for King County.
Oh, there's 2018.
I know, we go back about 10 years on this one. There's months on the side. There's date at the bottom. Okay. Inventory. In the event that we took how fast houses have been selling over the last few weeks, months, right?
Okay.
And we stopped all houses from going on the market as of today.
Today, no more houses on the market.
No more houses on the market.
Boom, no more houses.
And we keep up that same rate. How long would it take for us to sell out of houses? Okay. That's our inventory.
That's your inventory. Okay.
Right? So
months of inventory.
Months of inventory.
Okay.
If right now, all the way over to the right, we're seeing that we are out about 0.8 months of inventory in King County.
What? Point. Decimal point.
Less than a month's worth of inventory.
Less than a month.
No more houses go on the market.
0.8.
We will sell out before we hit a month out.
Is this a seller's market or a buyer's market, Darcy?
Yeah, so that's a great question. We're still completely in a seller's market. Yes, they're not 100%. Getting 27 offers and 400,000 over asking like they were earlier this year. But the seller still has way more power than the buyer right now. That being said,
yes,
when we look at like December, when there was, I don't know,
less than a half a month.
Why did people keep calling me? Wow. This is crazy.
Darcy's really busy listing houses right now, everybody. So get your house on the market before.
Normally, I answer phone calls. I just want to say this right now. There are a handful of times that I don't answer phone calls, and in the middle of a podcast is one of those.
Maybe we need to kick it back to live and actually like answer these calls real time.
I think we should.
That would have been really fun with the University of Virginia asking me for money.
Something to consider.
Yeah. We should do that.
Thanks, producer Jay. We would definitely consider that.
So if we look back to like December, where there was, I don't know, like a week's worth of inventory, that was you look at this graph, it's the craziest seller's market we have absolutely ever seen.
Yeah.
But if we go back to 2012, we were above 5 months of inventory. That's considered a buyer's market.
Sorry, you popped my balloon. I was going to say, what is eye-catching about this, you guys, is a stable market is somewhere between 3 and 6 months worth of inventory, right? So the closer we get to 3 months worth of inventory, we're starting to edge on the side of the seller. As we get closer to the 6 months of inventory, we get higher and hotter on the buyer side of the coin. We have not had a, quote, stable market since 2012. That's 10 years. We've been sub 3 months worth of inventory for 10 years.
Yeah. So it means over 10 years now, we have had a seller's market. Period.
So when we look at house values going up like this, we can start to understand that there's not enough inventory.
Right.
So what has to give? Price. So
you can't change the location. The quality doesn't change. Price is what you have to get.
Price is what you get.
So even though things are changing,
not too much.
It's not changing much on the inventory side. And I want to point out, yes, it looks like it's going up pretty fast right now, but it's the spring. This is when inventory always goes up. I mean, look at the 2018 spring. 2019 spring. You can see it jumped up.
So let me ask you a question.
Please.
How important is pricing the house today?
Massive.
Compared to any other market?
There are markets that it's more important, but I mean, it's always important. Meaning, if you price it too high, you're in trouble. So a lot of people look at it as, if you price the coffee too high, well, then less people are going to come. So eventually you drop the price and then more people will come and you're good. With houses, we're no longer under that perception. When a place is priced too high, it doesn't sell. And then a month later, instead of saying, we should just offer less, the buyers are saying, that place has been on the market for a month. What's wrong with it?
Yep.
And nobody wants to be the one to buy the thing that has something wrong with it. So you're better to price it lower and try to have the market take it to where it needs to be if you get multiple offers. But you don't want to price it too low because you don't want to only get one offer and not get what you could have got. So this is where it's not science.
No.
There's a lot of art to it. There's a lot of research to what's happening with that particular type of house in that particular area, taking into consideration the school systems, the town that it's in, the features of the house. Like, there's so many particulars. And I tell all my clients, here's the data. This is what I recommend. But I'm not the one that has to live with the sales price. That is you. This is where I recommend pricing it, but you get to choose where we're actually going to price it.
So important. Pricing is so important.
Most people follow the recommendation. Sometimes they don't. Sometimes they say, yeah, nice. I'm going with here because I want to make this much. Okay.
You know, when you were saying that, it's so funny. Once the property's been on the market for three weeks or a month, you know, people are like, what's wrong with it? You know, the island of misfit toys popped into my head. It's like the island of misfit overpriced houses that missed the mark and nobody wants to go see them now. And so it's super important not to
don't prejudge places.
No, don't prejudge places on the buy side. Yeah. Don't prejudge places, but on the sell side, be prudent with what you're doing and come at it from a very practical and pragmatic approach. You'll be successful.
And know that the market changes, right? So something might have gone on the market at a reasonable price 2 months ago,
which is no longer reasonable today.
The market has changed.
Yep. That
one didn't get absorbed. Therefore, it now is overpriced.
Yes.
I mean, that's just, it is what it is. And some people are chasing the market down.
Yep.
Some people are saying, no, my neighbor got this. I'm absolutely certain I can get it. Well, your neighbor got it a year ago. That's different. Or your neighbor's house has these features. Or your neighbor's outright lying to you, which actually happens, which is hilarious to me because we can see the numbers. Why are you telling people you got that? Different point.
Your neighbor's a liar. Liar, pants on fire.
Oh my goodness.
So, I wanted to just touch really quick on one last thing on the mortgage side of the coin, and then we're going to get into our Mythbusters for the day. Adjustable rate mortgages, love them or hate them? Darcy?
Arms,
adjustable rate mortgages. We talked a little bit about them last show.
This is generational also. Baby boomers hate them. Millennials think they're amazing.
Yep.
It's all perception of what your experiences with them in the past.
Yes.
One of the reasons why baby boomers tend to hate them, because last time they were around, there was a lot of ARMs with balloon payments.
And prepayment penalties.
Yes.
And no income verified and no assets verified.
Right.
And
so a balloon payment, let's just say like, oh, I got an ARM for 5 years. At the end of the 5 years, you switch to a different rate. And by the way, you owe $70,000 at one time.
Yeah, the balloon no longer exists.
Thank goodness.
So that is not part of the gig. But the adjustable rate mortgages are something that people should consider right now.
Absolutely.
It allows them to fix the interest rate at a lower than market standard.
Yep.
Right. So if market standard's 5 3/4 today on a 30-year fixed, maybe the ARM, just for an example purposes, down at 5. Right. So they can get 0.75% better in interest rate, and that interest rate's locked up for 7 years. Won't go up, won't go down. So it's worth having the conversation. And the question that I ask every single client of mine that is worried about an ARM, they go, "Oh, Keith, I don't know if I can do an ARM. It just scares me." The question that I have, or that I ask my homeowners, is, "How long have you had your longest mortgage?"
Yeah, how long are you going to be in the house?
How long are you going to be in the house? How long have you had your longest mortgage? The cool part about it is when I pull your guys' credit reports for the last 10 years, I get to see all your trade line history, and I can guarantee you, I could probably count my clients on one hand that have had a mortgage longer than 7 years.
Yeah.
One of them paid her 20-year mortgage off completely, made her last payment. And when she made her last payment, 2 months later, she called me up and she goes, "I want to sell my house and buy another one. I need a mortgage." Like, I love you.
Okay.
But long story short, guys, adjustable rate mortgages are a great way right now to combat increasing interest rates with an adjustable rate mortgage. So don't fear from them. Get educated about them. They're an amazing, amazing tool for you to be able to get in at a lower payment.
I think they're a great tool. I think you, like Keith said, you just have to understand what the specifics of that tool are. Because you haven't used one before, or you haven't used one in many, many years, and they've changed. So know what you're getting into. If your eyes are wide open, if you understand it, they can be a really, really cash saving piece.
Okay, we're going to jump into Mythbusters. So let's adorn our goggles.
Oh, goggles.
Here we go. Our favorite part of the show.
Okay. Dun, dun, dun. This isn't working. Hold on.
Oh, she's got to take off her headset. Got to take off the headset. Okay, Darcy.
Yes.
Today's Mythbuster is you can believe every headline you read in the newspaper.
Absolutely. If it's newspaper?
Newspaper, news, whatever.
Social media?
Hey, I still get the newspaper, by the way. Every morning it's out on my driveway. I go out, I pick it up, I read the newspaper. It's hilarious, right? Anyway, true or false? Can you believe everything you read in the news?
False.
Okay, false. That is absolutely correct. So I want to give you guys...
It's true? Just kidding.
Yeah, false is true. I want to give you guys a quick example. Two publications issued a very different take on the same numbers.
Ooh, I don't know this one, so this is good.
They're foreclosure numbers.
Oh.
So one publication goes out and says foreclosures are up 2,000%.
What?
Year over year. Factually accurate. Factually accurate. Year over year. Year to date, in 2021, we had 2,000 foreclosures nationally.
Okay.
Why do you think that is?
We had payments stopped. People didn't have to make payments.
Everybody was in forbearance.
They were in
couldn't
forbearance.
foreclose on anybody.
Right.
So yes, of course we've got like 2,000. How we had those 2,000, I don't know, because I thought there's a carve out. If it wasn't Fannie Mae, if it wasn't Freddie Mac, if it was FHA, you could still foreclose. Blah blah blah. So fast forward to today, the number came out for month ending May, and there's been 22,000 foreclosures year to date filed nationwide.
How many houses are there nationwide? That's barely anything.
Statistically, that is under 1% of all houses in America. Way
under 1%.
So, flip side to that, the other headline that I read, foreclosures still near all-time historic lows and are lower than pre-pandemic levels.
Also true.
Also true. But just such a stark difference in the coverage and the application of said story to induce fear or induce a sense of confidence. So what's very interesting to me, and as I grow older in this life, is you get to feed your brain with the information that you put into it. So be very, very careful as we go through times of change. You want to make sure that you're looking at the whole picture and you understand the whole picture and not just one side of the coin. Because I definitely, in my conversations with buyers and sellers and real estate agents, understand what the whole market is looking like so you can have a very educated, decisive movement and decision going forward. Because, I've heard some pretty crazy things.
Oh, yeah.
And factually, they can be accurate. But from a pragmatic standpoint, they're totally wrong.
It reminds me of when I hear my son speak or one of his friends come over and they tell me a fact. Like, where'd you hear that? Oh, well, so-and-so's dad said that. I'm like, well, clearly their dad was being sarcastic because that's not true in any form or fashion. You believe what you want to believe, but I would suggest some fact checking.
Yes.
I would also not, this is a hard conversation that I have with a lot of my clients. Don't listen to your friends, your coworkers, your brother, your sister, your parents, your aunt, uncle. Don't listen to them. They have no idea what it's like to be in your shoes. They don't understand your financial position. They don't understand what the market is like where you are.
Yeah.
They haven't bought or sold a house in 14 years. Like, there's so many things. Don't listen to them.
And to that point, what you're hearing is their limit, right? Their concern.
Right.
That's what they're perpetuating out there. Again, the phone call is free.
Yeah.
You can give us a call. Get data. Darcy has so much access to so much data out there for your neighborhood, for the county, for whatever you want to look at.
Yep.
So right now, I think as we continue to go through this time of change, prudence is a key word that everybody should be applying to their next housing financial decision. Sell and buy, whatever that looks like, invest in more real estate.
And when you see something that makes you go, wow, don't stop there. Think it through.
Dive deep and give us a call.
Yep.
So there you go. Don't trust everything you read in the media, because it could be there's something in the middle that's right. Anyway, so there you have it, guys. Times are changing. It's still a great time to be in real estate. It's still going to be on the long haul an amazing adventure if you go down that path. And we look forward to helping you out in any way, shape we can. If you guys enjoyed today's show, please like, share, comment, ask us any question. It doesn't even have to be real estate specific. Just questions. And we can
tell you where I got my sweater.
Oh yeah. Does this color not look great on Darcy? It's amazing. And the goggles actually go with your outfit today.
They do. The yellow.
Just saying it. Jay, let's make sure she turns those goggles in before she leaves the studio, okay? So, right on. Well, join us next month where we dive deep into another great topic, real estate specific. And until then, have a great and happy and safe 4th of July.
Oh, have a fun 4th of July. I love that holiday. Maybe it'll even be summer weather by the time we get there.
I hope so.
Fingers crossed.
Have a good one.
Bye, everyone.